One of the things I want to talk about today are the steps of tax planning. The first step is honestly just knowing what you own. There are a million different kind of businesses that you can own in various different account types. You have IRAs, which are taxed differently than Roth IRAs. You have non-qualified brokerage accounts that are taxed based upon what you own inside of that account. You could own a C corporation that is taxed differently than an S corporation. You could have a partnership, a sole proprietorship. All of those various things have their own tax character, and they're going to funnel into your tax return. So the first step of tax planning is knowing, what do I own and how is it taxed? Step 2 of tax planning is, after you understand what you own, it's how much income is going to be generated from all of those various activities. So you might have an idea of how profitable your business is going to be. You might have an idea of how much qualified dividend income you're going to get from your portfolio, or what your short or long-term capital gains are going to be from a portfolio. You might understand how much money you need to withdraw from an IRA, or if you have any annuity coming in. The moral of the story is every asset is going to draw income into your tax return. That's going to filter through various different things, and you're going to get a number that determines taxable income. When you have that, your brain should start to think, am I in a low bracket, which means should I pull more income into this year? Or am I in a high tax bracket, in which I should try to defer some into the future? This is not a static thing that happened once. It's something that should be determined on an annual basis. Step 3 of tax planning is to ensure you're not a prisoner of the moment. You have to compare your tax situation today and the tax situation tomorrow. That might seem strange, but the reality of the situation is a lot of people have retirement accounts where they have got a tax benefit today. It's not a true tax savings. All you're essentially doing is saying, I'm not going to pay the tax today, and I'm going to pay it in the future. Well, in order to determine if that's a good idea, you need to know what you're going to pay in the future relative to what you're going to pay today to determine if it makes sense to do any sort of transaction. And that is the thing that gets lost in translation with many clients, because they think pre-tax savings is tax savings, but it's truly just deferral, and you need to know what happens in the future to confirm that it saves you any money at all.
Black Diamond Financial Solutions, your trusted partner for a secure financial future. Contact us today to experience the difference that expertise makes.